Welcome back to another episode. In today's program, we're going to talk about Larry from Colorado that used his self-directed retirement funds to invest as a limited partner in a commercial real estate project in Baltimore. And as a passive investor in this particular project, not only did he do very well financially, but he made a major impact on the local community. Now we're going to break this down. Number one, we're going to talk about how did he find the opportunity. Again, he's in Colorado. He's investing as a passive investor, as a limited partner in a real estate partnership in Baltimore. This is a commercial building. We'll talk about number two, the process that he went through. There's a three-step process to establish the account, fund the account, direct the investment, and then monitor and manage the investment. We're going to break that down for you. And then number three, the impact on the community. As Larry says, it's not always about the returns, but also the impact on the overall community. So welcome back to another episode. If you haven't already, make sure to subscribe to our YouTube channel and hit the bell icon so we can alert you to all of our upcoming videos. Let's get started. What was the motivation behind Larry using his self-directed IRA to invest in this passive limited partnership opportunity rather than just keeping his money in the traditional stock market? Well, let me read a quote directly from Larry. This is actually in a written case study format on the Equity Trust website. Larry says, "I wanted to diversify away from the gambling hall of the stock market. To have all of your investments just in stocks and bonds with the volatility we have and crazy things like this coronavirus, it's always the perfect storm of what derails us and nobody sees it coming." So from Larry's perspective, he prefers to invest in passive real estate opportunities rather than the traditional financial markets. And as you will learn here at Equity Trust with the Universal IRA, you have the ability to invest in both the public markets and the private markets. Going on, Larry says it's not just about the return on investment, it's also about the impact on the community. He says it feels good to be investing in a property where a lot of high energy and creative people interact with each other and have a community. Remember, this property is being leased to a number of small business owners and entrepreneurs in the local Baltimore community. Okay, so let's talk about how did he find the opportunity? Well, remember, Larry lives in Colorado, but he has roots in Baltimore. He has family and a lot of friends. So when he was visiting there one time, he met with one of his old friends, and this friend introduced him to the individual that was acquiring an old building. This building was over 100 years old. The goal was to acquire the building, renovate the building, create a number of different offices, and then begin leasing those offices to small businesses and entrepreneurs. He also had a major tenant, which was a mid-sized software company. So he had a good strategy ahead of the game in place, and Larry simply came in as a passive limited partner on the transaction. So Larry's friend, Richard, introduced him to this individual that was putting together the project. We call this individual a general partner. So with real estate syndications or real estate partnerships like this, you're going to learn there's GPs or a GP, general partner, and then there are LPs or limited partners. Larry's IRA was a limited partner, not a general partner. The general partner was the one that was going out and actually acquiring the building, doing all the renovations, hiring the individuals to do so, and then working with the tenants to lease the individual units out. So Larry met this individual, and Larry went through the paperwork to invest in an LLC, a limited liability company. So the general partner formed a LLC, limited liability company. That LLC is what was used to acquire the building. And then Larry's IRA is an equity partner in that LLC known as a limited partner. All right, so just so you understand the structure of that. So that's how he found the opportunity. How do other individuals find opportunities like this? Well, it could be online. There's a variety of online forums and different ways in which you can connect with investors in a virtual environment. Or also going out and meeting other individuals, going to conferences and seminars, and identifying these opportunities. So there's more resources than ever to get access to these types of investment opportunities. But remember, just like Larry, you have to perform your own due diligence on all of these investments. And that's exactly what Larry did. All right, step 2 is the process. Of course, due diligence was a component of the process. Now, we break down this process in 3 steps. Step number 1 is open and fund the self-directed account, or as we call it here at Equity Trust, a universal IRA, because you have the ability to invest in both public assets like stocks, mutual funds, ETFs, and then also private assets like real estate syndications or real estate partnerships that we're talking about. So he established and funded his account. Step number 2, he directed his monies from his self-directed IRA, or again, as we call it, a universal IRA, directly to the bank account for the LLC for this particular project. Now, of course, there was paperwork involved in this process. So what was the paperwork involved in the process? Well, Larry filled out what's called a subscription agreement. So that was filled out as his IRA as the investor. So rather than it saying Larry in his last name, it said Equity Trust Company, Custodian, FBO as in for benefit of, Larry's IRA. He filled out the subscription agreement, gave it to the general partner. He also had a copy of what's called the private placement memorandum. So this reviewed for, or was a summary, if you will, and in detail for Larry, all of the information that he needed to do due diligence on the project. He also received a copy of the LLC operating agreement. So there were 3 documents that he had: a subscription agreement, an operating agreement, and the private placement memorandum. He submitted those documents to Equity Trust along with a direction of investment form, and then Equity Trust, his custodian, his trust company custodian, released the money, wiring the money directly to the LLC bank account. So now, instead of $100,000 in cash in his IRA, his $100,000 in cash was in the LLC bank account, and the asset in the IRA was an investment in an LLC. Now, oftentimes I'm asked, well, doesn't that mean he took a distribution? Isn't that a taxable event? It's not, because it's considered an investment. So cash leaves the account. In return for that cash is an interest in the LLC, his IRA as a limited partner owner in the real estate syndication or partnership. Now that takes us to step 3, which is monitor and manage the investment. So from there, again, Larry is a passive investor. So he was receiving a preferred return or preferred returns flowing back into his self-directed IRA, and then also profits from the proceeds and the profitability of the transaction. So all said, he made approximately a 15% cash-on-cash return on investment. So all of that profit, all of the preferred returns were flowing back into his self-directed IRA. Now, last but not least, we talked about the impact on the community. So from Larry's perspective, he was making about a 15% cash-on-cash return on investment. So he was satisfied with the results of the project. But it goes beyond just that, because he was looking to invest or diversify his money, remember, into hard assets like real estate rather than the traditional stock market. Additionally, he wanted to make an impact on the community, so he knew exactly where his dollars were being spent. His dollars were being used to acquire this old building, renovate it, and then lease it out to local business owners and entrepreneurs that may not have had a place to be able to operate their businesses otherwise. So an incredible story. I know some of you might be thinking self-directed IRAs feels a little bit daunting at times, or I understand that there are rules and guidelines that I need to follow. What you're going to find down in the details section or the description section of this video is a link to a course on our rules and regulations for self-directed IRA investing. So I'd encourage you to find the promo code. You're going to get a discount if you take action on this today. Until the next program, keep leveraging compounding interest in the absence of taxation. And a big thank you to Larry for providing this case study to us and sharing the message of utilizing a self-directed IRA, tax-deferred and tax-free, to not only make a great return, but also an incredible impact on a community.